Welcome to the Hawaii Captive Insurance Council Risk Topics Zoomcast. I am your host, Ward Ching, with Aon Strategic Solutions and Innovation Practice and USC's Marshall Business School. The topic today is parametric risk finance. What is it? How does it work? How does it play a role in risk finance and insurance? And what markets underwrite it? And what programs are using parametrics as a solution tool? My guest today is Michael Gruetzmacher, head of Aon's Alternative Risk Transfer and Innovation Practice, and co-leads the Strategic Solutions and Innovation Practice with me. Michael, welcome to the podcast.
Ward, thanks for having me. Good morning, and it's nice to talk to you in this format.
Yeah. You and I have had these conversations before. This audience probably hasn't heard very much about parametrics. So what I thought we would do is first of all, start with your background. Where do you come from an alternative risk transfer standpoint? What are the kinds of things you're working with? And then I'll bring up some slides and talk specifically about parametrics.
No, sounds great. Yeah, so I'll give you a little bit of my origin story. So I've been at Aon for about 15 years. I started my career actually on Wall Street. Entered the professional world with no ambitions to become an insurance broker, but here we are. But just fascinated by this industry, and then over my experience at Aon, we got involved in various different activities with clients, and that exposed me to the world of alternative risk transfer, which I guess I would define generically. I think our client base, they see the value in insurance, but there's also a demand to understand. Are there different ways to approach problems? Are there different ways to finance risk? I think it's puzzles like that really intrigue folks like you and me, and kind of really drives us day in day. And, that's kind of what leads to the parametric concept. It's sort of in the day-to-day interaction with clients, thinking about frustrations they have with traditional insurance products. How can we go about solving them? And that's where I think parametric insurance solutions can be really interesting to enhance the relevancy, solve different problems that traditional products can't solve for.
Yeah, no, that's good. I mean, this audience listening in will have a very heavy captive insurance company sort of orientation to them. And so one of the things I'd like to explore with you as we get through this conversation is what are the applications that you might see in a context with captives. So what I'm going to do is share my screen and bring up a presentation document around parametrics, and it really starts with the question, and I'm going to leave it in this mode so it's just easier to see. So Michael, what is a parametric coverage?
Yeah, no, great question. And I use a term sometimes called the parametric paradox, because this is a solution that might sound complicated if you're used to traditional insurance products. But at its core, this is pretty simple. So what this is, you can define this as event-based coverage, or if-then coverage, or like index-based insurance. But what we're really doing is looking at, all right, let's create an index that describes some risk issue. And there's independent data that might describe that risk issue or that index. And then it's the movements in that index that trigger the coverage. So a lot of the examples I'll use today will be about natural catastrophe risk, so hurricanes, earthquakes. You can also think about this for climate risk in general. But beyond that, I think the possibility is sort of endless in terms of situations where you can create an index, and find somebody willing to take the other side of the trade. So go through some examples with Nat Cat, which I think the simplest way to think about it. But maybe before we get into that, I think some of the value prop to think about is, I think, two main things: fast and broad. So by triggering coverage based on independent data, so this could be data around, let's say, a hurricane, it's very fast because the government is publishing that data on a real-time basis. So if we're using those parameters, we can adjudicate the claim quickly and get kind of capital in the hands of the client very fast. And it's also extremely broad. So this is one problem with traditional insurance, which raises the protection gap, or the difference between what our clients experience as what's insured versus their economic exposure. The problem is traditional products are very limited to things like property damage and ensuing business interruption, but parametric products can address a broader set of economic exposures. So let's say you have a business, let's say you're in the hospitality business, hurricane comes through, your asset is fine, but nobody wants to visit your resort. So you have huge volatility. That's something you could solve for with the parametric solution.
So in this particular case, you may have an insurable interest that is not impacted, but you have an economic interest that is.
That's right.
So under a traditional property program, it's really focused on your insurable interest. So what you're saying is that this is an approach to thinking about the collateral or the adjacent risk issues on the economic side. That's different fundamentally, isn't it?
Yeah, no, it is. And I think it's consistent with the theme I talk about sometimes, which is really top-down decision making versus, I think traditional insurance products are very much created on a bottoms-up basis. So, here's a risk, let's create an insurance product for it. But this is really thinking about it the other way around, which is to say, all right, if the client is exposed to a risk issue like a hurricane, how does that manifest? What are the issues that pop up? Which is a difficult exercise because all this is a little bit of a gray swan. If you can tell me what the event is going to look like ahead of time with precision, it's very easy to solve for that. But of course, we don't have that level of certainty looking into the future.
Okay. No, I mean, for the audience, the important thing to think about here is, for the most part, this is about property coverage, and it's about the BI issues and the adjacency issues. And what Michael is talking about, which is fundamentally important, is that it's a nat cat event. It's something that's triggerable and something that may also include economic interests, which is beyond the insurable interest space. So how does it actually work?
Yeah. And just to set up, this is kind of the overview which you talked about. I mean, I think you had sort of two takeaways. This is an emerging insurance category. So, maybe if we had this conversation 5 years, I'd say, nobody's heard of this, nobody knows what I'm talking about. Now I think the awareness is much bigger,
Yeah.
And kind of thinking about how do we apply this. And then I think the second takeaway is, think about this as a way to deconstruct what insurance does, or think about insurance in a different way, which I think once you do that, I call it kind of drinking the parametric Kool-Aid. You'll start thinking about all sorts of different ways that you can apply this. Yeah, then on this slide, just kind of want to go into some more of the details on how this could work. So on that exhibit, imagine on the x-axis, and let's use like a hurricane example. And you've got my mind on Hawaii, so let's think about hurricane hitting Hawaii. So you could say, all right, if there's a Cat 2 or less event, no problem, but I start to get concerned about my business if it's a Cat 3 or higher. So those category levels of the storm become the index. So it's really a combination of how close is the storm to your asset and what's the category level. And then you can see on the x-axis, you might have this set up where you start getting recovery for a Cat 3 event within 30 miles. And then the payout's bigger if it's a Cat 4 within 30 miles, and then even bigger if it's a Cat 5 within 30 miles. So then the y-axis on that chart is the parametric payout. So as long as you can find a way to correlate those payouts with what you expect to experience, now you've sort of perfectly solved it. So if I break that down, there's really 3 key attributes that drive this. It's one, the independent trigger. So it's not a debate between the client and the insured. We're all agreeing that let's look at this third party. It's fast, like I explained, because that data is available so quickly, and then it's flexible in that you can use the proceeds for any sort of economic exposure. I mentioned on here, a lot of this market is based on hurricanes, earthquakes, but also emerging products around things like hail, tornado, flood. Also thinking about like drought, excess precipitation, which has a lot of applications for a lot of different industries. And then also, wildfire. But wildfire is a little bit difficult just to find ample capacity. But I think this is where there's been a lot of product development and innovation in this space.
Yeah, I mean, one of the things that's really interesting about this is that unlike a typical property cover, where you have to demonstrate the loss, you have to go through the claims management process, which can be lengthy. I mean, imagine again, if you had the hurricane in Hawaii and half of Waikiki gets hit, can you imagine how long that would take to get through the claims management process? In the meantime, the owners of the hotels are out, right?
That's right.
Until they rebuild. So what this does is it basically says, if a hurricane, let's say it's a Cat 4 within 30 miles trigger, some limit with respect to that parametric coverage gets triggered, and they get immediately paid, right? Now, if they get paid, whatever the payout is, what are they obligated to use the payout for? Is it specified, or can it be anything?
Yeah, that's where I think this really gets super innovative, and you can certainly get way into the weeds on this, but you're right. I mean, I think if we think about that scenario and a traditional claims process, it's valuable, I think, to help the balance sheet, but doesn't really do much for the company strategically. Where if you have a 2-year claim process or something like that, I guess it's great to get that recovery, but it doesn't really help you get your business back on and operating again.
Right.
So this is where this is helpful. It's not, I wouldn't say this is a replacement for traditional insurance products. I think it's something to sit in the capital stack to really achieve kind of the best of both worlds. So on the traditional side, we can build a lot of capacity and it's very capital efficient. But on the parametric side, this is really about getting an infusion of capital, kind of a blunt force instrument to get things moving. And
Right.
and still accounted for as insurance. I mean, that's what makes this unique, is that that payout, it's really subject to like a loss attestation process where, let's say you get a 10 million payout, essentially if you can sign a piece of paper saying, all right, I've had more than 10 million of losses from this event, that's enough to satisfy, things from an insurance, definition point of view.
So in this next slide, it's really the interplay. So it's how the traditional program might work with the parametric. Can you explain this?
Yeah, no, absolutely. So yeah, if we work from left to right, this is similar to what I just mentioned in terms of, this isn't really a replacement. It's really something to complement or enhance the rest of the program. So if you look there, let's say you have a traditional program, you have risk that you retain, then risk transfer, and then of course what you retain if you didn't have enough limits. But then you also have this non-traditional event risk bucket. So everything that's not covered by that traditional property program. Then you add the parametric solution, and this really helps in 3 different ways you can think about it. Number one, this becomes a funding source for your large deductible, if nothing else. So at least you have that cash coming in the door. Number two, if you did have a situation where you didn't have enough insurance, you could think about this as excess from that standpoint. So this is all sort of gray swan, Cat 5 event hitting Hawaii. Don't know exactly what it's going to look like. You can engineer your buildings as much as you can, but you can't predict everything that's going to happen.
Right.
And then I think the most interesting bucket is this non-traditional event risk bucket, which is everything else that falls out of traditional property. This could be things like cleanup, the non-damage business interruption exposure. And then we can also think about things like, depending on what business you're in, that same event can have a huge amount of stress on your staff and other stakeholders. So it depends on the scenario, but the client might want to help those staff members do whatever they can to get things back online, and that's all expenses associated with that hurricane.
Right. You actually did something like that for a major technology firm on the west coast of California, right? Where you put a parametric around a NatCat event that specifically treated what happens with the employees. Can you quickly explain what that looked like?
Yeah, and I think it's consistent with this concept of like gray swan risk management, that I think you have to acknowledge that you can't predict everything of how this is going to look. So certainly when you think about earthquakes, I mean, it's been a long time, knock on wood, since we've had a catastrophic earthquake. But is society ready for that? Are we prepared for it? I think there's different ways to argue that, but I'd say probably generally not. So who knows kind of what would happen? So in that case, huge employee base on a earthquake exposed corporate campus. So the concern is, all right, if these employees' houses are destroyed, can they come to work? Or if all the employees are at work and can't get home, what happens? They just know it's gray swan. There are the deep pockets in the region. They're going to be looked at as a source to help systems, a way to alternatively finance that type of exposure, which is inevitable on some time horizon.
Yeah, no, that's really, really interesting. Now, going back to this particular slide, if you look at the left-hand side, you show the traditional program with retained position, risk transfer, and retained again. Is that something that could potentially be a captive kind of structure?
Yeah, no, it's a great question. I mean, I think with captives, I mean, a few ways I think about it. I mean, I think clients with captives tend to also be clients that are sophisticated about how they think about risk management and how they think about these issues. So there's a correlation there. Clients with captives, I think we have an interest in this concept. But also at a more direct basis, yeah, that client with the captive is probably running those retentions through their captive.
Right.
So they need to think about, all right, if the event happens, how do I replenish the capital base of the captive? And that's another use case for the parametric. So the captive could buy the parametric solution on the basis of you're going to use that to replenish the balance sheet of the captive. So same idea as if it was for the corporate.
Right. And that is a useful thought out there. So for those of you listening in, think about that scenario where you have potential nat cat positions. Now, here's another use case regarding the supplementary solution to the traditional program. Kind of explain this.
Yeah. This is an example of a deal we transacted earlier this year. So this is for a client with a large manufacturing facility. And that map, if you can't see, is Louisiana, Western Louisiana. And say they had a experience with Hurricane Laura, which I believe was a 2020, where they had a large ground up, I think $70 million loss. Large portion of that was self-insured based on how that program is structured. In this conversation, it's happening with this client maybe a year after Hurricane Laura, and still not a lot of progress on that claim, and it's a general level of frustration that they had a lot of costs and extra expenses, kind of looking for is there an additional solution. So that's where kind of parametric came into play. So you can see here on this map, I believe that's a 40-mile radius circle around the location, and you can see those. It's kind of like a spaghetti diagram. Those are some of the historical storm tracks that would have gone through that circle, and represent events that should be of concern if those were to repeat again. So that drives kind of the foundation of what's the issue we're trying to solve for with a parametric solution. And you can see on the next page kind of what the result of that is, which is so here's like a very real world example. So you can see on this map, same location, we have two circles, a 20-mile circle and a 40-mile circle, and then you can see that table on the bottom right. So that defines the payouts on the condition of really two things. Where did the storm track go? And what was the category level of the storm? So you can see different payouts, whether it goes through the 20-mile circle or the 40-mile circle, or the category level of the storm. So if it was a Cat 4, like Hurricane Laura, that went through the inner circle, you get a 75% payout. So this is a 50 million limit, or 37.5 million. And if we, the unique thing about parametric solutions is that you can backtest them. So you can sort of perfectly say, all right, if Hurricane Laura happened today and I have this policy in place today, what would my payout be? And we can answer that question. It's exactly 37.5 million. So it's very unique to parametric coverage, especially something like hurricanes, where I can easily pull up, I don't know, 120 years of data of just historical events, and then kind of look at that back testing to assess, all right, is this valuable or not? So in this case, yeah, they would pay about 4% rate on line, or 2 million per year for this type of coverage. And then if Hurricane Laura happened again, they'd get the 37.5 million payout, or even higher if it was an event worse than Laura, which certainly could happen. But this is what really attracts me, and I think a lot of buyers, to this solution, is it's just kind of very black and white, very transparent, and very fast.
In the short time that we have left, just a couple of more questions. Number one, who are the markets that are providing parametric coverage?
Yeah, I'd probably break it down to three different categories. I mean, I think the first would be kind of traditional insurance companies like Swiss Re, Berkshire Hathaway, where they have all the capabilities to assess and understand natural catastrophe and climate risk. So this is kind of repackaging their approach in a different way. So that's where a lot of the capacity comes from. The next bucket would be the parametric MGA space. So there's new entrants, new insurance startups focused specifically on parametric ideas. And I think they're attracted to it because I guess if as parametric becomes a larger concept, do you need all the claim infrastructure that a traditional insurance company has? Right. So if parametric's the future of insurance, it makes sense for different distribution models. And then the third bucket would be insurance-linked securities or alternative capital. So if you needed parametric capacity, you could, instead of going to an insurer, you could access let's say pension funds, hedge funds, who are interested in finding uncorrelated risks, uncorrelated to the rest of the market, and are also very attracted to this idea of parametric coverage and diversifying with climate and natural catastrophe risks. So lots of different sources of capacity. I think it's all of the benefit of our clients. And I think the challenge or the opportunity is thinking about where do we deploy this? How do we think about the risks that are covered or aren't covered? How do we think about the protection gap? How do we manage it going forward? And my argument would be protection gap is something we need to take very seriously. And the parametric trigger is sort of the killer app to address all this and match capital, that kind of risk.
Yeah, absolutely. And again, for all of you out there, this clearly matches up with the notion of using captives, understanding retention, and building around your traditional program to do something a bit more robust. Last question, Michael. What are the limits that parametric programs are affording now? I mean, is it only the jumbo programs, or are you seeing 20, 40, $60 million kinds of parametrics?
Yeah, no, it's a huge range, almost a huge, so big it's almost an unhelpful answer. So where I could go anywhere, if you wanted $1 million, $5 million of parametric capacity, that's certainly doable. 50, 100, also certainly doable from like a single insurer. Then I think you can go even higher when you talk about syndicating coverage. And then if I go back to alternative capital, we could really scale and build 500 million, $1 billion limits, things like that. Of course, it's a pretty small group that would need that much capacity, but these are large event risks and sort of different ways to think about it. So I think we'll kind of see developments like that in the future.
Well, Michael, thank you very, very much. This has been a really good conversation. Thank you very much for being on the podcast. For all of you out there, be sure to join us for future podcasts in this space, and be sure to join us at the upcoming Captive Insurance Company Forum in Honolulu in October. So with that, I'm your host, Ward Ching, for Michael Gruetzmacher. Thank you very much, and goodbye.
All right, thank you.